Welcome to this presentation on the capital asset pricing model. My name is Bill Bateman and I will be your facilitator for this session. We're going to be talking about capital asset pricing model, starting with an introduction as to what the concept is about. Then we'll talk a little bit about risk and return. We'll take a look at the capital asset pricing model formula and take a deep dive into the components, the risk-free rate, the equity risk premium, and beta, and then look at how it is applied to weighted average cost of capital. The capital asset pricing model was introduced by William Sharpe and Jack Traynor in the early 1960s. There was further work on this done by John Lintner and Jan Mosen in the mid-60s, and they were building on the earlier work, which you may remember from your investment classes that you may have had as an undergrad, from Harry Markowitz, who did a lot of work on diversification and the modern portfolio theory. Additional work was done with Black and Scholes in the 1970s, and you may have heard of the Black-Scholes model. What we're going to do right now is hear from one of the originators of the capital asset pricing model, William Sharpe.
It has to do with the relationship between the price of a security, its risks, and its expected return. And there are really sort of two key takeaways, if you will. One is that in that setting, the most efficient strategy for an investor is to hold basically a broadly diversified portfolio reflecting the market of securities that are available. And that gave birth to the notion of index funds. And the second is that there will be a reward in higher expected return, not guaranteed, but expected, for bearing risk, but the kind of risk for which the reward should be available is the risk of doing badly in bad times.
We'll also take a quick look now at an Investopedia video which introduces you to the capital asset pricing formula.
The capital asset pricing model, or Capm, is used to price an individual security or portfolio. The general idea behind Capm is that investors should be compensated in two ways: for the time value of their money and risk incurred. The model helps investors calculate risks and what type of return they should expect on their investment. The time money value is represented by the risk-free rate, usually a 10-year government bond yield, and compensates the investors for placing money in an investment over a period of time. That is added to the other half of the formula, which represents risk. It calculates the amount of compensation the investor needs for taking on additional risk. This is done by taking a beta, which measures a stock's volatility, and multiplies by its premium. The premium is calculated by subtracting the risk-free rate of return from the expected return of the market. For example, the expected return of a stock can be figured out in the following way using the model. If the risk-free rate is 3%, the beta, or risk measure, of the stock is 3, and the expected market return over the period is 11%. The stock is expected to return 27%. In short, if the expected return does not make the risk worth it, the investment should not be made.
One of the premises of capital asset pricing model is that with higher risk comes an expected higher return. So how does the expected return change with increasing risk? Well, let's take a low risk investor. They may buy something like a U.S. Treasury bond. Well, an investor with a little higher tolerance for risk may buy equities, or what we know as stocks, on the stock market. Now, a high-risk investor may just literally and figuratively gamble with very high-risk investments. Now, the low risk investor with the government bonds sees them as very little risk. In the capital asset pricing model, we'll be talking more about these. We consider these these investments to be somewhat risk-free. Although we agree all investments have some risk, these types of investments, the U.S. Treasury bonds, come with a very, very low default risk. These investors also expect a very low return because they have low risk. Now, the gambler has a high expected return because they're taking on great risk. And then the equity investor expects a medium return to equate to the amount of risk that they are assuming. You'll read in the Higgins text that there's two types of risk that each company faces. The first type of risk is systematic, and the second type of risk is unsystematic. The systematic risks are risks that all companies take in the overall market. So actually any investment in the overall market has these systematic risks. They're equal, they're even, they're what everybody faces, and they can't be diversified away. Now, unsystematic risk can be diversified away, and it is company or specific or industry specific. Here is a graph that shows the overall risk of a portfolio of stocks that can be reduced by diversification. Now, risk is measured here on the vertical axis with volatility, or in this case measured by the standard deviation of returns. The horizontal axis shows the number of stocks that would be in a portfolio. The blue area on this graph is the risk. And what it demonstrates is that as you add holdings to your portfolio, and we would assume that these holdings would be diversified, you reduce the risk. Because not all stocks have the same risk given on any number of circumstances. So by diversifying, one stock may do well while another is not doing so well, but overall, the diversified portfolio would have less risk. Again, the blue area is the systematic risk, or the unsystematic risk, which can be diversified away. The pink area of this graph is the under-diversified or the systematic risk that there's really nothing an investor can do about. So most investors are focused on the unsystematic risk that can be diversified away with a properly constructed portfolio of investments. So we'll take a look again at the capital asset pricing model formula. And this is what we've already seen in the video from Investopedia. But you'll see that it starts with the risk-free rate plus beta times the return of the market minus the risk-free rate. And this part of the equation right here also equates to the equity risk. Now again, the risk-free rate is a long-term treasury bond rate that we usually use as a proxy for a risk-free investment. Beta is the measure of risk, and I've got the formula for beta here for you math geeks, and we'll be taking a deeper dive into that later. The expected return of the market is determined using the S&P 500 as an index, and then we subtract out the risk-free rate to come up with the equity risk premium or the market risk premium, which represents the return that an investor expects by being in the market above the risk-free rate. So now we're going to take a deep dive into each component of the capital asset pricing model formula, and we're going to start with the risk-free rate. Now, the risk-free rate is the rate of return, as I've said, that an investor expects for a risk-free investment. Now, we all know, as I've said, that there's nothing that's totally risk-free. But the closest thing that we can get to approximate this would be the long-term U.S. Treasury rates. These instruments are backed by the full faith and credit of the United States government. They have low risk because of their low default risk, meaning that the government will always pay on them, or at least has up to this point. So in return, they have a low expected return. Now there's different types of risk-free rates or risk-free investments that the U.S. Treasury offers. They come in maturities of 1 month, 3 months, 6 months, and 1 year. They can also go out to 5 years, 10 years, 20 years, and even 30 years. These rates are determined through periodic auctions, and the rates are published daily on the U.S. Treasury website. These rates are often displayed on a chart which we call a yield curve. And by looking at different yield curves, we can foresee certain events that may be ahead economically. Now this is a normal curve, and the curve, as you'll see, has the yield or the expected rate of return on the vertical axis, and then the maturities are displayed on the vertical axis. And you'll see, as you expect, that a investment with a shorter maturity would have a lower expected return or a lower even actual return, while those investments with a longer term maturity would have a higher rate of return. We know that risk does get larger or get increased as time goes on, so therefore you should be rewarded for this risk you're taking by holding on to the investment for a longer period of time. So this is the normal curve. Now sometimes we'll see a steeper curve, and this may indicate that there's an improving economy, or at least optimism among those people that are buying longer term investments. A flat or a humped curve might indicate that things are slowing down a little bit, and investors really don't have a lot of faith or don't really understand what may be happening in the future. An inverted curve typically means that we've moved into or are moving into a recession or a downturn in the economy. These curves are rare. This is the current yield curve, and this line indicates the actual returns, but these are adjusted for inflation, and so this line here represents the real rates. Again, inflation is already included in the yield curve, and that's going to be important when we start using this risk-free rate in calculating our discount rate. And the question always comes up, what about inflation? Well, think back to this chart and this gap between the real rate and the nominal rate that we'll be using in our formula. This is the inflation right here. Now the long-term rates, the 20 and the 30-term rates, are the ones that we'll be focusing on and using in our Capm formula as we go on. So the question comes up as, which rate do we use when we're looking at the Capm or the capital asset pricing model formula? As far as maturity, when we are valuing a business, which is what we're going to be doing going forward in this class, you would use those long-term rates that I just indicated on the previous yield curve slide, usually the 20-year rate. Now, there may be times, like in a capital budgeting project, where the project has a finite life, say 5 years or 10 years. At that point, the analyst may want to match the risk-free rate that they would use in the Capm model to the maturity of the project and the maturity of the risk-free rate investment. So at that point, if the project, say, were a 10-year project, and at that point it was going to be liquidated and everybody would go home, then you would use a 10-year rate. Now the second question that we have to answer when looking at what type of rate to use is, are we going to use the spot rate or the current rate? And there's problems with using that current rate. Like right now, as we'll see on the next slide, the rates are historically low for a number of reasons. So what you want to use is a rate that's going to be good over time. So you could use a historical rate or an average. Or you could use a normalized rate. And we're going to see here in a minute Duff & Phelps, which is a company, a consulting company that pretty much is the Bible. They put out annually the Bible for valuation analysts, and they suggest for things like risk-free rates and equity risk premiums that valuation analysts should use for the next year. This is pretty much how I felt just a few weeks ago when I received my Duff & Phelps handbook. Now, it wasn't my name in the phone book that I saw, but I got almost excited as Steve Martin does in that clip when I got the Duff & Phelps handbook recently. As I've said, Duff & Phelps is a consulting firm, and annually they put out this handbook for valuation analysts, and it's the premier global valuation and corporate financial information that analysts will use for the coming year. As we'll see here in a minute, they're recommending a normalized risk-free rate of 4%. Now, they would prefer to use spot rates, but as we're going to see in the next slide or two, the current spot rates just aren't sustainable. They're at all-time low levels. So what they've done instead is use the normalized rate, which estimates a rate that will most likely reflect what we could expect to be sustainable over a long period of time. And they do this by looking at long-term forecast and then a build-up model where they take the real rate and add in, or the forecasted real rates and add in an expected inflation factor. The reason that they cannot use the current spot rates or the current rates as quoted today is due to the fact that we have historic low interest rates right now. And the central banks had a lot to do, this Fed rate that you hear, every time, Janice Yeltsin sneezes, the rate goes up or down. The Federal Reserve rate is kind of the basis for all other rates that are set. There's been a flight to quality in investments lately. There's been a lot of foreign investments in U.S. Treasuries. The recent increase in the value of the dollar, the low inflation risk that we've had, are all factors that have been attributed to these historic low rates. They've gotten so low that the Bank of Japan, which is the Japanese equivalent of the Fed, has recently set negative interest rates, which is unprecedented. And that's to encourage people to increase spending and decrease savings. So in this instance, with a negative interest rate, you'd actually have to pay to invest your money in these investments. There's also been a deleveraging of the private sector, meaning companies just aren't borrowing right now. Those companies that went through the 08-09 downturn found out that they could operate very lean, and they've kept those best practices even as some people think the economy has increased or improved. And so there's a great hoarding of cash among U.S. businesses that survived this period, and they're just not borrowing. So the basic laws of supply and demand would dictate that the rates, which are used as a start point for lending rates, would be lower. And here's a slide where they estimate that U.S. companies have over $1.4 trillion. I've heard that number could be now as high as $1.7 trillion of cash on their balance sheets. And here's just a few companies and the amount of cash that they're just sitting on. These figures were as of about a year ago anyways, and probably higher today. And here's a chart that shows that this is the 20-year Treasury rates. They are at almost historic lows, at 2.4 in January of 2016, And checking the rates as of June 15th, 2016, the 20-year Treasury rate is at 2.01. So it continues to go down and really is at a historic low rate. So the future, well, Duff and Phelps say that short term there are probably still enough significant factors that will keep these interest rates at artificially low levels. However, in the midterm, barring any major setback in the global economy, investors seem to be expecting U.S. interest rates to start rising, albeit slowly, after 2016. Now, the Fed has already made one move to raise the Fed fund rates by 0.25%, and there's some talk that that may go up another 0.25% over the summer of 2016. So this presentation being prepared in June of 2016. Those of you who watch it later will see what has happened. So here's what Duff and Phelps say is going to happen to the rates. And we start in 2016, and they're calling for a 10-year Treasury bond rate of 3.4. We're not even there yet. And they say that it would go up to 5% by 2021. And you'll see here, they're expecting this by the end of 2016. I think that's a little bit ambitious, going up to 5% here. And the way they created this rate is they found a 10-year rate, because it's easier to forecast and maybe more accurate to forecast out 10 years than it is 20 or 30. And then they just factored in inflation to come up with the what they call a build-up rate, or an implied rate, I should say, by taking a 10-year forecast and adding in a premium for inflation. Another way they can do it is using a build-up model, and what they did here is they took a survey of different analysts and the Fed banks actually, and came up with a range of 1.8 to 2.6 as a range of inflation, added that to the actual long-term real rate, and came up with a midpoint of 3.8. So what Duff and Phelps have come up with is instructing the financial analyst and valuation analyst for the next year at least to use this 4% rate as a risk-free rate. Now, having said that, you should still go to your case data and go to your case study and use the data to determine the appropriate risk-free rate based on the data in the case. And the reason for that is these cases are set at a specific time period, not at today's date. So you should always be writing the case as if you're in the time that the case was written, or at least talks about. So the next part of the formula that we'll talk about is the equity risk premium, which is determined by the risk of the market minus the risk-free rate. Now, the risk of the market is where we typically start in calculating this part of the formula. And normally what analysts will do is look at a long-term average of the returns on the S&P 500, usually 15, 20, or 30 years. Some go back all the way to 1928. And we found that the average return since the S&P 500 inception is 1928 through 2014. It's been about 10%. It's not so important that you go back as far as you can. It's important that you choose a average on a return that you think is sustainable over time into the future, and that you describe how you got it in your report. So this graph shows, going back to 1935, the ups and downs of the market over time, and it comes back to an average return of somewhere between 9 and 10%. Now, the expected return on the market is often just a historical average. So the average return for the S&P 500 since 1928, as I said, has been 10%. and this is using a geometric versus an arithmetic mean. This is something that you probably should Google so they can make the determination when you're looking at the Nike cost of capital case. There's a part there where you have to make a determination between a geometric and an arithmetic mean. So most analysts use the geometric mean. I would suggest that you go and at least understand, at least basically, what that means. Now, Duff and Phelps, they back into a expected return of the market a little bit different by getting an implied cost of capital and then adding to that the risk-free rate. So they've come up with an estimated equity risk premium for this year of 5.5%, and the estimated risk-free rate of 4%. So backing into it that way, they would have the expected return of the market as being about 9.5%. Now, in cases like Nike cost of capital and your final valuation report, again, use the data that's found in your case to calculate the Capm formula. So again, Duff and Phelps for the year 2016 has suggested using an equity risk premium, which again in the Capm formula is that expected return of the market minus the risk-free rate, and they come up with a 5.5% recommendation, although use case data in your work. I'm just showing you what the industry uses in the sources that the industry evaluation go to come up with these rates. Look, it's a bird. No, it's a plane. No, it's Dr. Beta Man. This is a nickname that I acquired after going through this part of the lessons with students in the past, and it's kind of stuck. Okay, now going back to our Capm formula, the final piece that we're going to look at is beta, and I saved this for last for two reasons. It's a little bit more involved in its calculation, and we will be looking at a video that shows how to calculate beta. The good news is that you're not going to be required to do that, but some people understand things better when they see how they're calculated and see the detail that goes into calculating them. So again, we have the risk-free rate plus beta times the equity risk premium. And again, the second reason that I waited till last to talk about beta is if you go back and you look at the risk-free rate, that's set by the treasury rates. The equity risk premium is the average returns on the market minus the risk-free rate. So the only thing that would change from one company to another would be beta. Okay, and beta is calculated using a regression analysis. And what you think of beta is as the tendency of a security's returns to respond to swings in the market. So if the market moves, how does the company's stock, is it volatile or does it move pretty much with the market? Now, a beta of 1 then indicates that the security's price will move with the market. A beta of less than 1 means that security is less volatile than the market and therefore less risk, so would result in a lower Capm and eventually a lower discount rate. And a beta of greater than 1 indicates the security's price would be more volatile than the market, so indicating that security would be more risk, have a higher cost of equity, and most likely a higher average cost or weighted average cost of capital, given all other things being equal in terms of the price of debt. So, for example, if a stock's beta is 1.2, it's theoretically 20% more volatile than the market. Now we're going to take a look at a video that gives an example of how to calculate beta on Excel. Now, this example is real heavy-duty regression analysis, and that's for the benefit of the math geeks in the audience. But the good news is that you're not going to be expected to calculate beta. But sometimes watching this calculation can be helpful in understanding what it represents. So I suggest you watch it once or twice and try to see if you can predict what the beta is going to be when you look at the line of best fit, the slope of that line. Again, when calculating Capm, use the information in the case to estimate beta You may have to lever or unlever it, as you'll see in another video, but you will not have to calculate the beta from scratch.
In this tutorial, you will learn to create a historic beta. In finance, we use the word beta to represent risk, defined as the relative volatility of a stock's returns to those of the market. We use a simple line to represent this relationship. You might remember from your high school geometry that the formula is y equals a plus bx. In this case, we will replace the b with the Greek beta. In this exercise, we will be using a stock's returns as the dependent variable, or y, and the returns from the S&P 500 as the independent variable, or x. The beta we will calculate is historical, though we often use it to estimate the required return for the stock into the future. On the spreadsheet, you can see 3 columns of data. In column 1, you will see the date for each pair of data points. In column 2 and column 3, you will see the closing prices for the Standard & Poor's 500 index and the stock for that date. Now let's calculate the S&P 500's returns. Since returns are calculated from one period to the next, we will have no data in cell E5. Go to cell E6. To calculate the return from January to February 2002, subtract B5 from B6 and divide by B5, the index level on January 2002. The result, as you can see, is a loss of 17.0925% over the month. Next, we will repeat this process using the copy function until all the returns are calculated. Now we repeat this same process for the stock. Now that we have created the returns series, we need to estimate the beta. Our next step is to plot the data in a chart. Now to chart the data. First select the data you want to chart. Now select the chart icon on the bar. Once you have selected the chart icon, you will see a drop-down box where you have a number of choices. Select the XY scatter and press Next. In this small box, you will see a miniature of your chart. Click Next. Add titles for the X-axis and the Y-axis. Click on the legend and remove the legend since we don't need it. Continue to click Next. Finally, you get a chance to place your chart on the same sheet or as a separate sheet in your workbook. We are going to put it as a separate sheet in our workbook. Now to calculate the beta. With the chart open, go to the toolbar and click Chart. In the drop-down menu, choose Add a Trend Line. From the menu box, choose Linear, and then go to the Options menu. Click on the box to display the equation on the chart, and the one to display R-squared value on the chart. Click OK. As you can now see, the beta for the stock is 0.8593 in the regression. This beta represents a stock that moves in a way similar to the market, but is less volatile. And the R-squared is 0.8627, indicates that the variance of the stock returns are highly related to the variance of the S&P 500 returns.
So the issue comes up that on any given day, you could calculate the beta for a company, and you could take some really valid, reputable sources and look it up, and you could come up with as many different values as many different sources that you looked at. So recently I calculated the beta for Apple, and I used a spreadsheet similar to what we just saw in the video, and I came up with a 0.98 beta, almost as close to 1 as you can get. Google Finance was also pretty close at 1.01. But then Yahoo Finance came in at 1.44. This is frustrating to students. It's one of the realities of finance, though. All of these are right. How can that be? How can these be different? Well, it comes down to the data that you're using in calculating beta. It can be the time period or range. Normally they use about 3 years. Some betas will go out 5 years or maybe more. The time series, they can be using data on a daily basis or weekly basis data or monthly. And you put that together, the time series, the time range against how often they measure the data, and that comes out to the number of data points can be different from one source to the other. And then it can be something as simple as when did they collect the data? They could be collecting it weekly, but one analyst could be doing it Monday, one could be doing it Friday, another analyst could be looking at an average for the week, or they could be looking at some other set frequency that we haven't discussed. So here are some betas of various assets, and I'd like you to take a few minutes right now and maybe jot these down. I'll give you a little bit of time here in the video to think about what investments might these betas represent, and think about what you know about beta and then go from there. And here are the answers. Apple, as we've seen, has a beta of about 1, as does United Parcel Service. Some of the financials and insurance groups, which have a little more volatility in the market, have higher betas like 1.9. Eli Lilly and Johnson & Johnson, pharmaceuticals, less volatility, long-standing companies in a stable, mature market, beta of 0.5. Yes, there can be a beta of 0. Think about cash, which the cash that you put under your mattress and save would have no relationship to the market movements and therefore has a beta of 0. And yes, there are negative betas, such as precious metals, which have a beta of about negative 0.5, moving contrary to the market. So I'll take a quick example here of a Capm formula. We're going to assume a risk-free rate of 4%, a return on the market of 9.5%, and a beta of 1.25, which indicates a company with volatility slightly higher than the average market as represented by the S&P 500. So then we go through the math at the bottom here and come out with a cost of equity using the Capm formula of 12.53%. So what does this all mean? Well, when you go back to calculate your discount rate or using the weighted average cost of capital, you can use Capm to calculate that cost of equity. Now there's other methods that you'll read about in the NACFA training manual information in this week's readings. And those are the Ibbotson build-up model, which is really used in a pretty efficient manner for smaller and privately held companies. One of the problems that you get to in trying to come up with a cost of equity for a privately held company is that they normally don't have a beta. Now you can use public company information to estimate or come up with an implied beta for a similarly structured private company, but the Ibbotson build-up method has really been proven to be a better method for smaller companies. And then there's also the modified Capm, which is talked about in the same literature. We're going to focus and use the Capm for cost of equity in our cases. So I'll finish up by saying thanks for hanging in there. I know that this was a lot to digest. You may have to watch it more than once. You may want to come back to it when you're working on the final case, and certainly be able to use some of this information in putting your thoughts together for the Nike cost of capital case study due this week. Start to think about how all these things are building on one another to come to value, and think about how each component can affect value. Thanks and have a great week.